Okay, so to conclude today's program, we're going to have a panel discussion titled Today's Agriculture Finance is an Economic Driver. We do encourage you to submit questions for the panel in the Q&A box at the bottom of your screen. Serving as moderator today is Bruce Clevenger. He's one of our brilliant OSU extension educators and serves as an associate professor from Defiance County, Ohio. Bruce is the very definition of professionalism in my eyes, and I look to him as a role model in extension. He has been at Ohio State University in an extension educator role for agriculture and natural resources since 1994. And his responsibilities focus on teaching and facilitating educational programs by conducting research. Clevenger utilizes a local research farm for agronomic research. He also specializes and teaches farm record keeping with Quicken and spreadsheets to farm groups and individuals across Ohio. At home, Bruce and his family operate a commercial sheep and alfalfa farm near Defiance, Ohio. Thank you for being with us today, Bruce, and leading a panel discussion on agriculture finance, and I leave it in your capable hands.
Well, Ben, I appreciate your kind words today, and would like to welcome our panelists. Ben, you have done a great job of putting together a great group of people. I'm going to do a quick introduction of each of our panelists today, and then we're going to dive into some prepared questions. So our first one that we're going to introduce is Aydah Benninger, and Aza comes to us today as the Executive Vice President of Community Bankers Association here in Ohio, and has over 18 years of banking experience with a specialty in retail and small business development. Aza graduated from The Ohio State University with a bachelor's in arts in communication. He enjoys being involved in his community. He has served as president of the Rotary Club in Westerville, Ohio, and also the director for the Rotary Honors Veterans 5K Walk and Run. He lives in Columbus, Ohio, and with his family, and he enjoys the Buckeyes football season, also golfing and running as well. We're also going to next introduce Greg Lyons. Greg is an economist who joined Farmer Mac team in 2019. Prior to joining Farmer Mac, Greg was an economist with the USDA Economic Research Service. Greg grew up in upstate New York, where he spent many hours on his family's dairy farm. At Farmer Mac, he spends most of his time researching topics related to credit access, land values, and farmer financial conditions. Greg has a bachelor's degree in policy analysis and management from Cornell University, and a master's in public policy degree from Georgetown University. Our third panelist, Gary Matteson, Gary Matteson works for Ag Credit's Trade Association in Washington, D.C. as a senior vice president for beginning farmer programs and outreach. This includes policy work on local foods, sustainable agriculture, and direct-to-consumer agriculture. He frequently speaks to beginning farmers, training on basic financial skills and record keeping. For 30 years, Gary was a small farmer raising greenhouse wholesale cut flowers marketed in the Northeast and beef cattle for local sales. He served on numerous boards of directors, including Farm Credit, the Boston Flower Exchange, and many nonprofit organizations. So welcome to the panelists, and we are excited to have them on board. We're going to start with a question for Aza, and we're going to give this that local lender feel for the conference here. And the first question to Aza is, how do community banks serve their communities? And then I have a follow-up question for that.
Absolutely, that's a great question, Bruce. In Ohio today, we have about 165 different community banks that are spread out around all of Ohio, anywhere from Conneaut to Hicksville in the Northwest, all the way down to the Ohio River and everywhere in between. So the primary ways that they serve their local communities is that they employ, they invest, and they serve in those local communities. Ohio's 165 community banks employ a little over 12,000 Ohioans, and that's spread out all over the local market. So there's not some concentrations there between the Columbus, Cleveland, Cincinnati markets. So it's really spread out across all of Ohio. But also, first and foremost, their business model is based upon local decision making. So it's very common when you walk into a community bank or you reach out to your local community banker that you'll have an opportunity to actually talk to the bank president or an ag lender. And in many cases, if you're working with an ag lender, in this case, many of the ag lenders throughout the state at many of our community banks are also farmers. I'm aware of several community banks throughout Ohio that allow their ag lenders time off during the spring plant or the fall harvest to get out of the office, go take care of their farm, and then come back when the season's over, very much like yourself there in Northwest Ohio. So additionally, it provides the borrower, the farmer, a little reassurance knowing that they have an opportunity to work with a fellow farmer, but also someone that's a banker that's there to help them and they've walked in their shoes.
Excellent. Well, thanks for that. A follow-up question deals with some consolidation that you might see in the banking institutions. And has that changed some services or some access to credit that would be available to those customers?
Yeah, consolidation is certainly a concern on behalf of the entire industry. If we go back just roughly about 20 years, there was 3 times the number of community banks that we have today. Nationally, we have just under 5,000, which is really important because when we go through a crisis like we did this past spring with COVID, those community banks provided 80% of the access for all PPP requests. So it really served as a very effective distribution channel to get the proceeds of the PPP money into those local markets. So consolidation is a big factor. Fortunately, most of the consolidation tends to be from the national or super regional banks that may exit a small community market, but oftentimes a small community bank that may have already been in that market, or if there's a neighboring community bank, they may move into that market and take advantage of that opportunity because they do see a need in those smaller communities.
Is there a developing concern regarding some of that consolidation for the local communities throughout Ohio and maybe other reaches of the Midwest?
Yeah, I mean, that's a great question. It's been happening coast to coast for the last 20 plus years. And so while it is a developing concern, as we saw this past year, while traditional bank hours have kind of gone the wayside, there's been an increase in acceptance of new applications, whether it be online or mobile access. For many of the community banks, they experienced 5 years worth of growth in engagement with those online or digital applications that normally would have taken 5 years. So we added an opportunity to actually leap forward in terms of providing that access. So while consolidation is an important part of the industry, improving access through online and digital channels has improved significantly.
So as a community bank, are there some certain services that they're looking to provide at that bank to build or to build market share?
Absolutely. Remote deposit capture is one that's been around for almost 20 years now, and that's been a very effective one. And that product in particular came out as a result of 9/11 when all the planes were grounded. The checks couldn't travel from bank to clear. So the financial system instituted what we called Check 21 at the time, which is where you have an opportunity to get a check to clear electronically. And a perfect example of how that utilization is included is if you receive a check from a family member or a friend, and you can now take a picture of that and deposit it to your local account. That's one of those enhancements that continues to provide improved access for everyone.
Such a great feature. I love it. I really do. So as we often see, rural populations are declining and farms consolidate. Are there some pressures that places on some community banks as far as their diversity or diversification or expansion of that portfolio, or is that not an issue?
You know, that's a really wonderful question, and it is an issue, but there's also many layers to it. In terms of diversifying or expanding their portfolios, I'm going to say that's more of a longer term issue that's still going to be several years down the road. But today, the bigger challenge in the short term is with those populations shifting from the more rural to the more urban markets, is that the banks are facing challenges in terms of attracting and retaining top talent in those local markets. And so keeping that farmer in Hicksville or Defiance to work at the local bank and actually become an ag lender, that's the biggest challenge in the short term. And so there is a tremendous amount of opportunity for those that may have left the rural community to go to school at OSU or one of the extensions, but there's a significant opportunity for them to go back. And when they do go back to those local markets, there's also additional benefits. I mean, one, they're working in a small community that's very well connected. They have a very strong foundation and they're invested in one another and their neighbors. But also the cost of living could be significantly different, providing more opportunity in those rural markets versus an urban market. And also from a career pathing, there's better work-life balance than you might find in what I'll say a Cleveland, Columbus, Cincinnati market.
Excellent. Well, I appreciate you mentioning those communities in my county in which I work in, Hicksville, Sherwood, and Defiance, all have community banks associated with them, and plus some other farm credit, ag credit associations as well. So appreciate that, Aza. And we're going to jump next to Greg. Greg again with Farmer Mac. How is adoption of new technologies impacting lending, all the way from security protection, credit access, and then also financial education, Greg?
Yeah, absolutely. Great question there. First thing I'd have to say that I think these are incredible tools that we have because, as you mentioned, there is some concern about consolidation in the industry. Now, I believe those concerns are somewhat unfounded. What we have seen through this year is that mergers and acquisitions are actually down among community banks and are on pace to be their lowest that we have seen over the last decade since the ending of the financial crisis. And what the hope is that what these tools are going to enable is they're going to enable those community banks to have the agility to underwrite credits that they might not have had the opportunity to before, and really kind of focus on providing that credit opportunities for borrowers who might have been harder to score without those things. I mean, we've seen a lot of really incredible tools that we have been looking at, things like looking at the expected revenues from a piece of land just by looking at the typology information that you can see from it. You can just generate a cash flow literally just by looking at what they've planted and where they are. I'd also have to say that it's kind of funny to talk about technology adoption too, because in some ways, just to get kind of this, what you were talking about with Aza, is this is still a somewhat recalcitrant group in that farmers tend to be, they tend to be older, they tend to be in rural areas, and they're still much more likely to go to a community bank location. About 40% of people who access banking services will go into a physical bank branch. Now, that doesn't mean that they're not going to use alternative tools. So what we have seen is that in the last year, the share of those sorts of borrowers, those agricultural borrowers, they are going to be using online tools about 25% of the time, but critically, they're also starting to use mobile tools as well. And so some of what the government has been doing, things like the Rural Digital Opportunity Fund that's putting $20 billion into rural broadband infrastructure, those are ways to, even for this somewhat recalcitrant group, to give them a way to connect to finance. But again, as I would say, I think this is actually a group that is still very focused on using a lot of local tools at their disposal in order to access the capital they need.
So that gap in rural broadband certainly impacts to the ag lender. You mentioned some of those things for the customer. What other opportunities and that relationship between customers, what impact is it on the ag lending community by having an improved or enhanced rural broadband?
Well, again, as I mentioned, I think the key thing is just that capital access. And so what we're really hoping for is a robust competitive environment here. And so when you have borrowers who are better able to access either online tools, mobile tools, that just means that there is more credit competitiveness in any environment. And we're ensuring that our producers are getting the best cost for their credit.
Excellent. Well, thanks, Greg. We'll come back to both Aza and Greg. We're going to jump gears over to Gary. Again, Gary with Farm Credit Council and the work that he does there. So with the farm credit system, they're written into that charter is an obligation to prepare programs for furnishing sound and constructive credit and related services to young, beginning, and small farmers and ranchers. How is the Farm Credit Council, but also the farm credit banks across the country fulfilling this mission?
Well, Bruce, the Farm Credit Council, of course, is the trade association. That's who I work for. My job was created back in 2008 to help the local farm credit associations like Ag Credit and Mid-America Farm Credit there. for helping them with their young beginning small farmer programs. So those programs all of that delivery of programs is at the, let's see if I turn my video back on.
We might have paused your video because the audio was skipping a bit, and so that might save some bandwidth on your end.
Well, Bruce, I look about the same as I did 45 seconds ago, so no change.
Thank you.
Gives me a chance to scratch my nose here. Thank you. So the education programs that get delivered by Farm Credit, there's education as one big aspect of service to beginning farmers, and then the other would be more financially based services to beginning farmers, like a lower interest rate or lower lending standards or paying FSA loan fees or something like that. And over the past decade, as interest rates have gone down and stayed down, realistically, we've seen that beginning farmers are a lot, I can't say they're less interested, but they're less motivated by just saying, oh, you know what, we'll give you a lower rate because you're a beginning farmer. Much more important has been the idea that farm credit institutions, associations across the country are providing education programs. And that really has engaged farmers in a very different way. In some cases, in order to get, like at Mid-America Farm Credit, the beginning farmers are required to participate in a 2-day-long financial skills training seminar as a condition of them getting their low rate. So it's kind of a carrot and stick sort of approach, that the idea is to build a better borrower over time. Different parts of the country use different ways, different programs to help educate beginning farmers, and that's really become a key component of what Farm Credit does, along with the sort of the nuts and bolts of who Farm Credit is, which as a cooperative allows probably a higher degree of consultative lending, meaning that that loan officer that sits across your kitchen table from you is aware that you as a farmer borrower are also the owner of the company, and that the relationship is perhaps can be a little bit more consultative in terms of, should I buy that tractor or not? And the loan officer can say, well, do you really think your balance sheet can handle that? What if? And go through some different iterations of what that risk may look like to that farmer.
Sure. I think there's a lot of teachable moments there that lenders across the country have with producers, and really engaging them in some thoughtful process about commitments that they're making financially. And so, Gary, a follow-up, is there a way that community members, including current agriculturalist partners, are there ways to support young beginning and small farmer programs?
Sure. There, to that sense of educational programs, Bruce, I think the idea of being other community partners, being willing participants in each other's educational programs, to as a for instance, in some of the programs that Mid-America Farm Credit has, they're inviting in other businesses, other providers of services to beginning farmers, and having them become part of that program. So it's sort of sharing the wealth when anybody in the beginning farmer business, if you want to put it that way, can gather an audience. When you, on an online conference like this, can gather an audience, I think it serves everybody better to share some of our time with each other and give more choices and more exposure to ideas to those beginning farmers.
Great. Let's circle back to Greg. Again, Greg's with Farmer Mac. And how has regulation changed in the 10 years since the Great Recession?
Well, I think we're going to have to split this out, talking about whether we're talking about the financial services industry or ag specifically. So is there a particular direction we want to go first there?
Your choice.
Well, I guess we'll start tackling this with the financial services side. Then I know that we've actually we've had a little bit of a different environment here as a GSC. We do have a slightly different regulatory environment, working with our regulator, the FCA. And so we have had to get to a more Basel compliant capital regime. And so we're talking a lot about things like CECL. We're talking a lot about changes in our accounting standards. And so we are there are changes in how we have had to work ourselves over the last decade or so. So there has been that. I think that is a significant source of change for a lot of agricultural lenders out there. But I would say on the agriculture side, we are. I think that I'm sure Todd Keithy and Annie would agree on this, that we have seen a period of a lower return on assets. We're talking about very tight margins here. And so whenever we talk about something like the regulatory environment for producers, talking about things like WOTUS, talking about things like the renewable fuel standards, what we're really thinking about is, are we giving a certain environment for producers that they can operate in? And I do think my dog has very specific opinions on this. You'll have to excuse. She is furious about the renewable fuel standard. You might have to circle the Aza here. I apologize.
We can circle back around. Let's jump down. Let's go back to Greg. Greg, how is Farm Credit working with customers in financial distress as a result of some of these lower commodity prices after we've come down off of the recent several years of highs?
Yeah, it's been a time that in good times, lending should be careful, so that in bad times lending can be bold. And I think that's what's happened over the past few years of this long-term sort of erosion in farm earnings that has turned into a real problem for a lot of borrowers. And one of the things that of course, speaking from a national level rather than specific about in Ohio, but I know in Ohio, I should say that in response to COVID, one of the things that Ag Credit did in the northwest portion of Ohio was voluntarily defer payments. So they contacted all their borrowers and said, you know what, if you've got a problem because of COVID, whether it's access to your bank or whether it's you ran out of checks and you can't get more, or you don't have the cash flow, whatever it is, it's okay to voluntarily defer those payments. Of course, you had to call into the office and say that I would like to do this. It wasn't a situation where you could just say, say nothing and not send the payment. But that kind of deferment out there as a possibility is probably one of the primary things that happened as a direct result of COVID. Mm-hmm. One of the other things that has happened as interest rates have gone down during this year, from early in the year in March, when the COVID crisis really took effect on our economy, there have been loan rate modifications. So that's a fancy way of a banker saying, we lowered your rate. And there have been some borrowers that have had 3 rate reductions over the course of the year, which is interest rate expense a high portion of any farm business's monthly budget? Well, probably not. But if you add it all together, having your rate lowered, it's one of those unusual calls from a bank or lender that calls you up, and I can see it looks like Aza's smiling too. When your banker calls you up and says, "Hey, I'm going to lower your rate," nobody hangs up on you. It's a good news situation. One of the other things directly related to COVID are the PPP loans, the Paycheck Protection Act. So Farm Credit was did not have the same relationship with the Treasury as did commercial banks. It took us a little bit longer to get them to write rules that would essentially allow us to get into that PPP program. But that ended up being quite a significant assistance to farmers. And I know that everybody thinks, well, it's some guy down the road that got this PPP loan. The smallest of those loans that was originated that I know of in Ohio was for $1,400. That's getting pretty darn small. Now, we hear about the big companies that get those PPP loans, but I want your audience to know that assistance reached a very broad swath of customers, and I'm sure Aydah could talk about that also.
We'll have a couple of those questions for Aydah regarding the PPP program as well. Appreciate that, Gary. Let's go back up to the barking dog room. Greg, I think he's got it under control. Let's talk some more about those regulations. And as you finished up your comments there, I wanted to see if there were any negative impacts to the agricultural businesses regarding those regulations.
So I would say that we're heading into an environment where it is likely now that we are going to head into divided government. It is likely that we're going to head into there being less action on the legislative side. And so I think really what we're going to be looking at here, and that we have seen over, I think, the last 10-year period, is a lot of change through the regulatory side, through the executive side. And what that does mean is that if you have this period of consistent change, is that you create an uncertain environment, even if the administration at the time attempts to create uncertainty. I think the challenge for producers is knowing whether that uncertainty is something that will bear out over the course of the change administrations. And I think I would see that being the largest source of risk is just the uncertainty as it stems from administration to administration.
Mm-hmm. Super. And just one follow-up question, Greg, as we're on the regulation side. The Farm Bill, recently the 2018 Farm Bill, doubled the acre limits from 1 million to 2 million acres on farmer MAC loans. What impact have you seen from that adjustment?
Well, note that's 1,000. A 2 million acre farm would be pretty big.
Oh, sorry.
But we'd be, that one we might have to review pretty closely with our underwriters. I can't say that we're definitely not complaining about that. I would note that effect didn't actually go, we didn't actually see that until the summer of this year. So I can't provide you with a lot of analysis about the net results of that rule for our own book. But our regulator at least has said that this is something that they don't believe will interfere with our safety and soundness. And so, our mission here is to serve all of agriculture. We are seeing this environment where a lot of producers feel like they do need to be fairly large just because profitability margins are so limited. And so I can say that we are, of course, very happy to serve in any way we can.
Appreciate that, Greg. Aydah, we're going to come back to you here now. The Paycheck Protection Program was mentioned, and also the economic injury disaster loans were authorized through the CARES Act here earlier in the year. And then about midway through the summer, we saw the second round of the PPP program was authorized. How have these policies worked to support your members and their clientele?
Yeah, thank you very much, Bruce. And Gary had mentioned a good point that some of these PPP requests were rather quite small. He had mentioned one about 1,400. I know of one that was as small as 400 from a community bank. So with respect to the first round of PPP, no program has ever been stood up like this in such a short period of time before. So for all of its hiccups and heartburn that it provided for the lenders early on, the SBA, I think, did an exceptional job trying to stand up this program and get so many banks access to the program that had not been plugged into the system before. When we take a look at round one in particular, that money went exceptionally quick. And for those that we're working with, I'll say the national or the large regional banks, they had, I'll say, I don't want to say elevated access, but they had improved efficiency to get that money. A lot of the community banks that may not have been plugged into the SBA program prior to round one, oftentimes only received their access after round one was entirely exhausted. So to your point, how important was round two? It was exceptionally important. And that money was distributed. It took a little bit longer to distribute at that point. But what was nice and convenient about it is the SBA did recognize that community banks needed some exclusive access. And for a couple days there, they did have exclusive access where community banks with finance assets less than 1 billion in size had access to the system. So there was fewer interruptions, fewer shutdowns, if you will, in the middle of an application. So that was real helpful. Here in Ohio, Ohio processed about 150,000 PPP requests for about 18.5 billion. And the average of all of those requests was right around 101,000. And so to Gary's point earlier, you know, $100,000 for a small business, it sounds like a lot, but if you've got a few dozen people on payroll or more, that'll go real quick. So this really did get into the hands of those that really needed it the most.
So if we had the chance for this policy to be authorized again, and one of our speakers earlier in this program mentioned that the possibilities of that discussion happening, are there any changes that you would like to see to the program, having lived through and worked and served clientele and customers through the first policies?
Yeah, absolutely. There's two in particular. One would be an exclusive carve out for community banks to have more access again. When they did receive access this past time, I think they received notice at 4 p.m. that they were going to have access from 4 p.m. to midnight. So they didn't have enough time to get their staff in and work all night to be able to do that, because they had about a 3-hour notice when they received that. So that would be one. And the second one would be an easier path for forgiveness. Right now, there's consideration for all lending requests less than 150,000 to be just automatically forgiven based on some supporting documentation. And that would accommodate about 87% of all the requests out there. And so that would be very effective and efficient and beneficial for those true small borrowers that were participating in the program. So those would be the two items that we would focus on.
Great, appreciate that. We're going to jump over to Greg again, and from the Farmer Mac standpoint, from their view of some lending institutions, financial health, are there any conclusions that you could have, or perspective of any of those that are in financial strain, that if they're experiencing that, do you have any conclusions or summaries about maybe their status?
Sure. I mean, I think that across the spectrum here, my guess is that, and what we have seen is that most lenders would say that the support that producers received this year was instrumental towards stabilizing the financial health of the system. What we saw is that we did see a lot of 90-day delinquencies. We did see a little pop kind of earlier this year, but that all of the cash that has come since that point has helped stabilize those systems and has started to bring down some of those levels that we did see earlier this year. I don't think we're out of the woods this year, but there were a lot of really good bits of information for producers. I do think a lot of the off-farm income that some producers rely on tended to be, they were in areas that were more insulated from the broader macroeconomic downturn than other areas, which also helped stabilize their income. So a lot of stabilization for incomes for producers that helped us even after this initial period of uncertainty. And from our own perspective, we saw far people asking for deferments related to COVID-19 than we would have expected otherwise, which at the onset of this pandemic, I think we were thinking a very different outcome there. But that's not to say that there isn't strain. And I think that a lot of times the strain here is fairly obvious. If you looked at a map of call reports very early this year, you'd see a lot of people in dairy country are starting to see a lot of strain. And you know, luckily since then, if class 3 milk's at $23 a hundredweight, you know, they're feeling a little bit better these days. But generally we see that a lot of community banks especially can be very impacted by the local conditions and the local commodities that they are subject to. And just because we've seen so much volatility this year, as Courtney sort of alluded to earlier, there was so much volatility, so much uncertainty that there was a lot of concern heading into the end of this year. But since then, we've gotten a lot of good news on commodity prices, a lot of good news on the macro economy. a lot of government support, and I think that people are going to close out this year feeling significantly better about it than they did even just a couple months ago.
Appreciate that, Greg. We're going to finish up with two questions. One, same question for Gary and the same question for Aza. This is kind of from that local lender, that local bank perspective. In the next 3 to 5 years, what concerns might you have about the financial institutions, ag lending, and your ag clientele? But then finish this up with something that you're excited about, something you're excited about we look forward to. Let's go with Gary. I'll give you the first step at that. Again, one concern, the next 3 to 5 years, and then what we're excited about as we also look forward.
Sure, good question, Bruce. So in the next few years, a big concern would be continued attention to management by farmers. That they've got to, not that they don't know what they're doing at all, but the longer farm business or any business is in a distressed situation with low commodity prices or whatever the particular challenge is, the more it demands of that farmer business person to manage for the long term, to try to make sure to preserve working capital, which I think will be a big challenge for farmers. And it's, in terms of financial performance, that's probably the big one to put up there on the board. But also to make sure that they're still finding success in what they do. There's only so long that any business person, anybody in any walk of life, can, be beaten down, hold their head down, and not see a good day, right? So that gets to the second part of your question: is what's there to be optimistic about? And I'm always optimistic about beginning farmers. The kind of energy that somebody who is looking at new possibilities brings to an industry is always welcome. It helps all of us in the room. Well, back when we used to actually get in rooms together, to have the energy of those young farmers and ranchers around us. The young men and women that are entering agriculture are not blind to the challenges that are there. They're just pretty well convinced that they can figure out how to work through those difficulties and have an idea of success that is probably going to take them down different pathways. So that's what I see as the bright spot, is that I've got younger people than I behind me looking at a very bright future. And part of my job is helping them find the right pair of sunglasses, because I want their future to be so bright they got to wear shades.
That's great, Gary. Appreciate that analogy. Aza, let's wrap this up, and your concern, and then also your positive looking forward.
Yeah. As far as the concern in the next 3 to 5 years, Gary kind of touched on it, and I'll echo that, is anytime someone's going through financial distress, especially for an extended period of time, it creates more opportunity for pitfalls. So to the lenders out there, to the bankers, or to the ag borrowers out there, I would say engage one another, have conversations. There's an exceptional amount of tools, industry resources. I know Ben's got several programs there at OSU to help the farmers. So have healthy conversations with one another, because it's going to be tough waters for the next few years. And as far as what am I excited about? As challenging as COVID has been, a year ago, nobody would have ever given thought that we would be having a conference in a digital format. And so, as frustrating as it is, when there's market disruption of any sort, it creates all kinds of opportunities. And so I'm real excited about the opportunities that will present themselves in the next 3 to 5 years. Maybe it's fintechs introducing themselves to help provide further access to the ag borrowers through online channels or otherwise. So I think the opportunities out there are significant.
Well, we're very thankful for the three of you, Aza, Greg, Gary. You described, I think, a resilience in our industry. And one of the strengths that we have in agriculture is our lending institutions and the support to provide the capital and the operational dollars to do what farming does. And so I thank you again for your professional jobs and the work that you do that really does reflect into a resilient organization that you have, and then a resilient industry that we all have. Ben, we'll pass this back to you.
Yeah, thank you, Bruce, and thank you to all of our presenters today. We really appreciate the time that our panelists spent with us on topics, and then our presenters, our three presenters earlier today. I do have just a couple of concluding remarks, and then we'll wrap up the day. Remember to come back tomorrow if you had a good time today. I remember we have another 3 days of exciting information planned. Tomorrow we'll be covering agriculture and environmental policy with 3 more excellent presentations, one on carbon markets, ag labor, and one on biofuels. We'll finish the day as we did today with a panel discussion. That panel is titled Evaluating the Sustainability, Viability, and Efficiency or Effectiveness of the Federal Farm Safety Net. So make sure same place, same time tomorrow. We invite everyone back for another excellent day here at the 2020 Ohio Agriculture and Ag Policy Conference.